Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Kriegmer. I'm a wealth advisor here at Kriegmer Wealth, and today I'm joined by our senior wealth advisor and founder, John Kriegmer. And John, we got a lot of ground to cover today. We're going to be talking about some economic things. We're going to be talking about some retirement planning things.
Yeah.
But before we do that, how you doing?
I'll tell you, I am running like a person that I'll even say I'm running like a chicken with my head cut off. I guess we'll kind of go old school on that. So it is just crazy right now. With the information is coming hot and heavy, the numbers are just coming out, and they're impactful numbers. Drew, it's things that have been kind of percolating over the last 3 years. And we've been able to see the impact of that recently with inflation just jacking up last year, and then interest rates pushed higher because of that. Well, we always know that decisions have consequences. So should a decision have been made or not been made from a federal government standpoint in 2020 and 2021? Well, we always let truth be the judge as far as good decision, bad decision. I think that everybody, regardless of where we sit as far as with our political persuasion, we all would agree that every single decision, that it does have outcomes or it does have consequences. And so it's a matter of saying, what are those consequences or what are those potential outcomes? How does that play out? How does it affect you in the real world? And then from there, what are the best decisions to make? And so we're going to cover a lot of data today, but not just data for the sake of data or information that kind of like, oh, what in the world's going on? But actually, we're going to walk through how does that actually put you in a position to make better decisions regarding your finances.
Totally agree. So John, let's hop into it. I think that's a great way to tee us up here. So first chart we're going to walk through, this has to do with U.S. government spending over the last 12 months, going back all the way to the early 80s, along with the U.S. federal tax receipts going back over the same time period. And what you'll see as we kind of move from left to right is there really isn't that much variation in either chart. There's swings up and down, of course, but for the most part, pretty consistent until you get to 2020, where we see a massive increase of 66% in U.S. government spending before a massive decrease and then a subsequent increase of 14% so far this year, while U.S. federal tax receipts are actually down 7%. So, John, we're increasing government spending while we're decreasing how much tax revenue is coming in. And if I'm remembering correctly, I thought government spending was quote unquote frozen recently by the Congress. And so can you kind of walk us through what are these numbers? Why are they important? How does this affect not just inflation, but also future tax rates and the economy at large? What should we take from this data?
Yeah, I would say you want to pay attention to this chart and how it plays out over time. And so anytime where we see a drastic decrease in spending within a very short period of time, typically it's 1 to 3 years later, you then start to see a massive increase as far as in tax receipts. Well, why is that? It's because, think about your individual life. If you go on making a decision, you have a season where all of a sudden you increase the amount of spending that you have. And maybe it's seasonal. Maybe at Christmas time you spend more money. And maybe you actually use credit cards to pay for that additional spending. You're going in debt. At some point in time, though, the effect of that debt comes to you in higher payments. And so maybe you want to pay it all off in January, February, and March. And so then you send extra money in to make the payments. Well, you have to have extra income or cut spending somewhere else in order to make those payments. Or maybe your monthly payments just simply increase and increase and increase until all of a sudden then you get yourself into a situation where nobody else will lend you money. The same principle, though, applies to the federal government with one additional caveat. So whenever we see the increase in spending, as we saw in 2020 and 2021, and then the decrease there for 12 months, and all of a sudden this rapid increase, which is the third fastest increase of federal government spending in the last 40 years. So we had the highest spending level in 2020, and now in 2023 for the last 12 months, it is the third highest. And I wouldn't be surprised if by the end of this year, it's actually the second highest in the last 40 years. Whenever we see that, then increase in tax receipts have to follow. And if they do not follow, well, then all of a sudden, then we're going to have a growing and growing national debt. And so it has not followed the last 3 years. So what does that mean? Our national debt now stands at $33 trillion. Well, that's all well and good. And you could be a Keynesian. So John Maynard Keynes, who is an economist, the guiding principle of Keynesian philosophy is that governments all around the world, since they're all interconnected, they can continue to borrow more and more money and never stop borrowing that money as long as everyone else is also increasing their borrowing. And so balance sheets all rise at the same time. And so right now we have Washington the last 40 years has been governed by a Keynesian approach of money management, which means that they do not have a problem with increasing debt and not necessarily increasing revenues to cover the debt.
And now, John, I guess one of the questions that just comes to mind, I've heard it from clients of ours, I'm sure you have too, is how in the world can this work? Because on paper, it doesn't seem to make sense. Is this just something where, we don't need to worry about it? Or is it something that we need to keep in mind as we're making those important financial decisions?
I'll tell you, it impacts you greatly in time. And so if we think about it then, at some point, though, the federal government does have to increase revenues in order to pay for that higher interest payments that they're going to have just by having a higher debt load. And so how do they increase revenue? Well, you could have the approach that we're going to actually increase our economy. And so we're going to increase the overall gross domestic product. We're going to have more development as far as of goods and services, more jobs. And by doing that and increasing the economy, well, then we're going to have an increase in tax revenue without increasing rates. The challenge with that, though, is that our population has been aging. And so with an aging population, they're more in the savings mode and not in the consumption mode. Therefore, it's a challenge for the economy to actually grow unless it grows by an increase in government spending. And so now all of a sudden, how do we pay for that increase in government spending? That comes from additional debt. And so we do not see the overall economy growing. Therefore, as far as at a very quick pace that we saw at different seasons as far as within our country's time. However, what we do see happening, though, is an increase in tax rates across the board, both on the corporate and on the individual side. Keep in mind, though, an increase in the corporate tax rate. History has proven that corporations simply pass on those extra taxes onto the end consumer. So that means higher prices across all goods and services for everybody because of the higher tax burden corporations are paying. So then that leads into a perpetual state of a higher than normal inflation rate moving forward. So it affects you as far as on the tax rate side. It could also affect you as far as with higher inflation moving forward. And some folks say, well, in the past, we've seen the government increase the debt load, and then they just have simply paid it down over time. Well, generally speaking, that works well philosophically when you have an environment where interest rates are actually low. But when you're in an environment where interest rates have gone up, well, then all of a sudden, then the U.S. government is paying a larger amount of principal on their debt. So it's gone now from $20 trillion to $33 trillion over the last decade. And on top of it, interest rates on the debt that they're paying have also increased. And so it's kind of a double whammy there. And that then puts them in a situation of how are they going to make payments in the future? It's going to have to come from increased tax rates.
Absolutely. I think, John, that's a great summary of just kind of where we're at. And I think this next chart that we're looking at really speaks to what you're talking about. The 3-month U.S. Treasury yield is at its highest level since January of 2001, which I know you've talked about what January of 2001 was like in the depths of the dot-com bubble. But really what this speaks to is it's the fastest increase in interest rates in history in an effort to bring down inflation, which there has been progress on that. But John, obviously, like you were speaking about, higher interest rates means higher interest costs on U.S. government debt when it comes to servicing the national debt. And 65% of U.S. bonds, government bonds, actually mature in the next 5 years, which means that interest cost is going to drastically continue to increase. And John, I think that definitely is going to translate to higher taxes for all of us here in the next couple of years. And so...
Yeah. Drew, I think that actually the impact of this is really staggering. So we look at the interest rate, and if you're a saver, you love the fact that now you can earn money on your savings account. So we have a Stonecastle relationship for savings for over $100,000, and it's paying an incredible rate of return here after Labor Day of 4.8%. Your FDIC is insured up to $25 million. And so if you're on the savings side, it's great because now you can have some quality savings rates. If you're on the borrowing side, and so whether you're an individual, whether you're a small business, whether you are in a government entity, when you're on the borrowing side, then actually those higher interest rates hurt. And right now it's created this incredible imbalance where people are trying to readjust their spending because the interest rates on their credit cards, on their car loans, on their house loans have all gone to a higher level. So it actually means they have less spendable dollars monthly or discretionary dollars monthly in order to take care of their family needs as they're walking through the season. So it does put us in an unusual situation. The other thing to realize with this drastic increase in interest rates is that I think we have a problem in our banking system in the fact that in order to be competitive, there's short-term interest rates, so savings, money market, and CDs that are shorter term, so 3 years or less. Those interest rates have increased drastically over the last 12 months. And so for a bank, a savings deposit or CD deposit, that's actually a liability to a bank. An asset for a bank is actually a loan. And so the loan rates have not increased as fast as the savings rates. Therefore, on their balance sheet, they're actually paying more in interest than what they have coming in on some of the loans they have on the books. And so it puts the banks in kind of an unstable situation. And so that's why we have seen a number of downgrades coming out of Fitch and Moody's as far as with banks out there. We want to keep our eye on that. But we're also starting to see from banks that we're seeing some variable interest rate loans. And so let's say for businesses that actually operate their business using an equity line, and some of them are carrying $500,000 or $800,000 or $1 million on their equity line. Their interest rates this fall are resetting. So they were paying 2 or 2.5% as far as interest on those balances they had on their equity lines. And now they're resetting at 8.5%. So prime is at 8.5%. So if you're a prime lender, you were paying 2.5% on the equity line. It's now resetting at 8.5%. That's a 6% increase. And if you're carrying $1 million on your business, that's an extra $60,000 of cost that you have. Well, that's probably 1 or 2 employees that they may be laying off of this next year. So we think there's some underlying problems with this drastic decrease and then interest rate increase that we've seen over the last 3.5 years that actually put some problematic situations as far as for clients and how they manage.
And John, I think a lot of people will hear all this and be like, hey, it sounds like you guys are building a case that things are really not as rosy as what they maybe seem when we watch the market having the year that it's had. How should people navigate this? I was reading recently that recessions usually come after the rate increase cycle plateaus. And so we're still in a rate increase period right now where the federal government's raising those rates. The Federal Reserve's raising those rates. So we're not at that plateau yet. But John, when you hear all these things we're talking about, it kind of sounds dire. But how should people navigate this as they're making those important decisions?
Yeah, you want to recognize that the economic cycle is continually changing. And so we always go from a boom to bust cycle, and there's different points along the way. And some of those areas are actually very stable as far as overall in the economy and how things play out for individual investors and for businesses. And so you want to recognize you're at a point in the cycle. And then from there, you want to say, what are the changes that I need to make to accomplish my goal objectives? And so never make a decision in the moment. If you're listening to talk radio or podcasts or looking at things in social media, you want to make sure you temper that because they always come from the most extreme position. You do want to recognize the facts and how things play out. And then from there, you're able to say, let's reassess our goals in the short term, intermediate term, and long term, and let's make some adjustments. So in 2022, we saw the stock market on the NASDAQ drop 37%. And in 2023, we're looking to be an up somewhere in that 35 to 45% range for the year. We'll see how the fourth quarter plays out. Well, that's a strong bounce back year. We should be thankful for that strong bounce back year. The S&P 500, even though it's had a bounce back, is still below the all-time high set on January the 2nd of 2022. But we're still positive in a strong way so far for the year. Well, that's a phenomenal time to take a step back and say, let's now reassess our overall strategy and your asset allocation in light of your goal objectives and where we're at in the economy. And so right now, I'd say you want to do a strong point of reassessing. So it appears we're getting toward the end of the interest rate increases. That we anticipate there may be one more. There's been 3 Fed Reserve governors come out in the last 2 weeks that have commented that they believe we're either at the end of the increases or we're close to the end of the increases. We're still watching inflation to see how that's going to play out. Federal Reserve Chairman Powell is trying to manage some expectations there, so the equity market does not get too far ahead of itself. However, we believe we're getting close to the end of the cycle. We believe there's probably going to be some level of slowing down in the economy in the first or second quarter of next year. That may be a recession, may not be a recession. We're kind of close to break even on that. There is a chance if rates go down next year, it's going to flip the entire conversation, both on equities, on the stock market, and also as far as in the bond market. And so we think it's setting up for some tremendous opportunities on both fixed rate opportunities, bond opportunities, and then also as far as on different type of equity investments, depending upon where an individual might be at.
Awesome. Thanks for the rundown, John. If you have any questions about what we talked about here, absolutely reach out to us or reach out to your advisor. We're obviously doing things behind the scenes inside of our client portfolios to make sure you're properly positioned for what's coming down the road. But we would strongly encourage you, if you're in that retirement yellow zone, so you're 3 to 5 years away from retirement, you absolutely should be having a conversation with your advisor on a more regular basis about what's going on. Just because, John, I think we're in a pretty unique environment. This is not the market or the economy maybe of 2017 or 2016 that was pretty clear where things were heading. It's definitely worth a conversation. But John, let's kind of shift on that note to a core piece of everyone's retirement income planning, and that is Social Security. And John, we get a ton of questions about Social Security. But one of the things, I just came across a chart the other day that I found fascinating, that the majority of workers claim before their full retirement age. And I believe right now the full retirement age is somewhere around 66 and 10 months to 67 years old for most individuals who are getting close to taking Social Security. But John, these numbers are pretty interesting that the majority of people take it before that full retirement age, even though the math, let's just say that the numbers say you're better off to wait to a longer or to a later age to claim Social Security. And so, John, when we talk about Social Security, I know there's a lot of nuance and there's a lot of different decision points for each individual depending on their personal situation. But what should people do with this data, or how should they approach Social Security?
Yeah, I think it's probably, it's always been important when your guaranteed income sources, which would be Social Security and pension, to make sure you do proper analysis to select the proper time to begin those income benefits. But right now, because of the things we talked about as far as with tax rates in the future, because of inflation, because of instability overall in the equity and bond markets, because of the federal government's increasing and decreasing of interest rates, which is affecting everything, it's more critical now than ever to make sure you do the proper analysis to actually give you information or knowledge so you can make a wise decision about when to begin your benefits. And right now, I think on that chart was up there, 29% of people start their income at age 62, whether they should or not. And I believe that the percentage that start before age 67 right now, it looks like about 82% start before age 67. And so whenever you kind of think about that, remember, keep in mind, folks, for every year you delay the beginning of your Social Security income, it increases by 8% a year. And that actually carries on for your entire lifetime. And if you're married and you happen to pass away, well, that will also affect your spouse's spousal benefit from a widow or widower standpoint. And so the decision has got huge, huge impact here in the short term, but it also has huge impact on the long term. And so I really want to encourage everyone to sit down and have that conversation before, at least 12 months before you are going to plan on beginning or at least before you're eligible to begin your Social Security benefit, to make sure you do the analysis. And the break-even point, Drew, for most people is 17, 18, 19 years to break even on it. If you start it earlier, so let's say you start at 62 instead of 67, but so you want to actually look at your personal health situation. You want to figure out how much, what is your life expectancy personally? What is your personal health history? What has been your genetics with your family? It comes down to it, Drew. It's all about having that incredible income plan. But then you can once you have the numbers, you can take your personal view as far as on the safety and security of Social Security, then to make an individual decision.
Yeah. And so what we would encourage all of you to do is to reach out to your advisor. If you're in, again, I'll mention it again, the retirement yellow zone, so 3 to 5 years away from retirement, get your Social Security statement, reach out to your advisor and pass it off to our planning team. Our financial planning team does a great job of analyzing all of these different ways for you to claim Social Security and finding the best fit for your unique situation. And so definitely reach out to us. We've had some great tools, John. Income Lab is a fantastic tool that can bring a lot of value on the retirement income planning side. So, guys, that's all we have for today. Really appreciate your time. If you have any questions, reach out to us. We'd love to chat with you. And otherwise, we'll talk to you soon. Have a good one.